Keir Starmer, the Prime Minister of the UK, addressing the Parliament on his meeting with the European Union. I mean, this is coming after Brexit. Well, welcome to the 300th MPC meeting of the Central Bank of Nigeria. And now we'll be looking at what will probably shape their decisions today. Now, as the Monetary Policy Committee prepares to communicate the decisions of its 300th meeting, both global and domestic economic developments are expected to shape its decisions. Globally, easing inflation driven by lower energy costs amid declining oil prices and trade tensions has led central banks to maintain dovish policy stances to support growth. And domestically here in Nigeria, the economy has shown resilience, supported by improved oil production, a recovery real sector, and relative naira stability. Headline inflation slowed to 23.71% year-on-year in April from 24.23% in March, and that reflects softer core and food price pressures. However, risks persist as analysts warn that exchange rate volatility may resurface due to concerns over falling oil revenues and the need to protect foreign reserves. Additionally, widening fiscal deficits and potential increases in government borrowing could further influence the committee's policy direction. Well, these are issues that are expected to shape the MPC's decisions today. But what do analysts and financial market players think? And that's why I have them right here with me, Dumebi Oluwole, Senior Economist at Stears. Thank you so much for joining me today.
Thank you for having me.
I actually saw you nod while I was talking about some of the potential risks, but of course we'll come to that later. Yeah. And also I have with me, joining me virtually, Segun Sopitan, Principal Partner, Woodridge and Scott Consulting. Thank you so much for joining me today. All right, so I guess I have you to start with right now. So looking at all of the things we've talked about, really, what's your expectation for today's meeting?
Expectation, I think just like most economists right now, is a hold on interest rates. And the reason is very simple. Even though we have seen inflation slow, we still see a lot of price pressures coming, especially from food. Seasonality is really kicking in. This is the planting period for a lot of commodities, especially tomatoes. And we do see price pressures ticking up from there. There are other commodities as well that are also feeding the food inflation basket and also triggering, inflation. While we think that, or while we see that price pressures are somewhat moderating from petrol prices, that aspect is somewhat like good news. But then again, we do know that food still constitutes quite a lot in Nigeria's food basket. Even though it has been reconstituted, it still holds substantial weight, and that will continually drive inflationary pressures. We're also still seeing insecurity be a very big issue, and how that is impacting food prices across the country. There's also the fact exchange rate has also been somewhat volatile. Yes, towards the beginning of the year,
I mean, it's very large. I would say it's.
Well, to an extent, but we have seen movement. For instance, between today and between yesterday and I think last week, we saw the parallel market and official market rate widening, and obviously market sentiments are already beginning to price that in. There are also concerns from lower oil prices feeding into exchange rate expectations, and how that will eventually feed into the exchange rate. So while right now it's somewhat stable at the official market, the widening gap between the official market and the parallel market suggests that there is some level of volatility that will likely happen and should have actually been happening right now. But then again, we are seeing buffers from the external reserves. With reserves beginning to rise, there will be somewhat support from the CBN to kind of defend the naira, support the naira, address whatever demand backlogs were noticing, or increasing demand. Basically, CBN could come in to somewhat support the market on there. But the main reason why I did mention that volatility is because of what we do expect from lower oil prices, and how that eventually would impact inflation and exchange rate expectations, and what that will do for the naira, and of course the widening gap between the official and the parallel. But that being said, we do know the CBN has maintained an orthodox stance, and we expect that to continue. And what that means definitely is that this volatility we are likely seeing, or we are likely to see, will correct itself. it will correct itself. Why? Because we do expect the CBN to ensure that, number one, revenues that they to ensure that our FX supply is sustained, FX liquidity in the market is sustained, to ensure that demand is met, and to ensure that the naira is stabilized around the current levels. What we are seeing is an exchange rate around 1,550 to 1,650 within that tight band. We do not expect it to go beyond that. But then again, who knows what happens with oil prices? And there was something that is extremely important for us to also gauge is oil production. You had rightly mentioned that right now looking at our oil production is extremely important because that obviously gauges how much Nigeria can hedge against shocks from oil prices. So Nigeria is very much sensitive, very much more sensitive to changes in oil production than prices. And if you notice, when you see oil production rise, almost like the markets are very happy, oh, Nigeria is doing well. But again, we need that rise to be very much consistent to eventually hit what the budget market is.
We're talking 1.68 million barrels per day. Is that even sufficient?
That's exactly what I'm saying. So we needed to get to 2 million barrels per day. And the reason is because S&P Global Platts had already done an estimation, I think around in 2021 or 2022, when we saw that first really big dip in oil prices. And what they estimated for a break-even point, the estimated break-even point for oil price for different countries. And Nigeria's was over $100 per barrel. So what that means is that for us at our current base production, right, at the time we were doing, I think about 1.1, 1.2, on average, but I think, about 1.2. With our average base production, we need oil prices at $100 per barrel to really break even. So what that tells us is that a reduction in oil prices with a base production of 1.2, it does spell very huge concerns for Nigeria's revenue.
But at 1.6?
But at 1.6, getting up to 1.2, with oil prices at maybe $70 per barrel, $75 per barrel.
60?
Now what I'm saying is, if you met it, okay. if you keep moving along the scale, right, oil prices around $75 per barrel, $80 per barrel, and oil production at around 1.6, 1.7 could still make the ends meet, but we do need oil production to increase significantly. So if we do have oil production at maybe 2 million per barrel, 2.5 million barrels per day, and oil prices at around 65, 70, we will still make good revenue. That's the point I'm trying to make, that we do need oil production significantly increase to hedge against the decline in oil prices.
Okay.
Yeah, so that's the point I'm trying to make. And with that, if we should obviously, the MPC will obviously consider that as a very strong suit. But for right now, with all the fundamentals that I've laid, inflation still has its threats from food prices. Decline in oil prices are definitely putting pressure on fiscal coffers.
So why hold?
We hold because interests are still high. The global interest rate environment right now, and remember that for the MPC to make a decision on either increasing or decreasing interest rates, they follow the trend in inflation. Okay. The trend in inflation, and follow the trend in global inflation trends and global interest rate movement. From the U.S. Fed side, before I even get into that, let's look at what is happening.
We'll come there later because we've now been joined by Dr. Samson Simon, Chief Economist, ARKK Economics Data Limited. Thank you so much, Doctor, for joining me.
Thank you for having me. Good afternoon, Nigerians.
Good afternoon to you too. And I'm also joined at this moment by Segun Sopitan, Principal Partner, Woodridge and Scott Consulting. Thank you so much for joining me.
Thanks for having me, Professor. Good to see you.
Good to see you too. Let me begin with you, Doctor. Now, the Fed held rates while the ECB and the Bank of England cut rates. Which of these do you see the MPC mirroring? Dr. Simon, if you can hear me. But I think I'll just take this to Mr. Sopitan. Mr. Sopitan, I'd like you to take it up from there. Are we going to see a mirroring, or this will be based on some fundamentals? Talk to us.
Fundamentals of our economy as we are today would suggest that the CBN, the MPC, will be holding. Any other thing, obviously, we will no longer be hiking. So it's either going to be a hold or a slight drop. But I think it's too early for us to see a drop. So it's very likely that we're going to see a hold because the fundamentals don't support a reduction in rates as at yet. money supply is still way through the roof. Inflation is only beginning to moderate on certain components of the food basket. We're still a bit high. All the other structural issues, the other structural reasons for that are driving inflation are still very much at play. So it's extremely unlikely that we're going to see a cut. But we should be expecting to see a hold rather than a cut, just based on the fundamentals alone.
All right, before we move on, I know we have all seen the inflation figures for April 2025. I don't know if anyone has any problem with those figures, or let me just get your general thoughts on them.
Well, inflation numbers, of course, we've done the rebasing. So from the time that there was a rebasing of the CPI with terms to the reference year, it was almost as if we're starting the journey afresh. So we needed to establish a trend based on the new rates before we determine what exactly is happening. So we can't take the drop from 34% to 24% and say, oh, inflation has dropped. We have to now look at 3 consecutive months of inflation numbers since the rebasing to determine what direction we're moving in. And as it speaks now, it does look as if things are moderating to a certain degree. And you will agree with me, and I think every listener that is listening to this would agree that indeed, in the markets, in the supermarkets, on the streets, some prices have begun to come down. So the price of eggs, for example, is no longer as high as it was, say, 4 or 5 months ago. We're talking 6,000, 6,500. Eggs have come down to 5,000, 5,500, depending on where you live in the country. And the same holds true for quite a number of other food items. And again, like somebody was talking about petrol pump prices at the PMS. Thanks to Dangote, thanks to the Naira for crude arrangements and all of that, we're beginning to see PMS prices stabilize at around 850 Naira to 900, depending on which part of the country you're in. So a lot of all these components of the basket have either stayed the same or dropped marginally. So that does account for why we've seen inflation drop from March to April, and I think the numbers ring true for most people based on eye test.
All right, that's quite interesting. Dr. Simon, if you can hear me, please confirm.
Yes, I can hear you now. Thank you.
All right, just before we move on, I would like to know what your expectation is from the CBN Monetary Policy Committee and why.
Well, I think I'll be expecting them to hold. And my reasons for drawing that conclusion is that the overarching objective of the central bank in Nigeria is price stability. And recently we rebased our CPI, which is the main metric that is used for inflation. And even though I know this is like, we have seen the data for inflation for 4 months, we have seen for January, we have seen for February, for March, and for April. I still think the central bank needs to be circumspect. They need to be careful about either hiking or cutting interest rates, because they really need to observe the horizon and really look at economic developments, whether domestically or globally. And globally, I know the last MPC they were talking about Donald Trump's tariffs. The tariffs are not completely gone. I know they have a hiatus. They want to see for the next 90 days how things play out. So it's not yet Uhuru. And even for the Russian-Ukrainian war, which is one of the global developments that the central bank normally observes, I think the best thing is to adopt a wait and see. And even for the Middle East, the problem is not there yet. And for inflation to be at 23.71 might seem like progress, considering where we're coming from and the fact that the numbers are easing. I feel that is not good enough for one to say, yes, we can now heave a sigh of relief. There's still a lot of work that needs to be done. So if I were in the position, if I were on the MPC, I think I will adopt a wait and see. And even for domestic happenings, if you look at our foreign exchange reserves, they seem to be doing okay, but they still, we have 10 months of, the reserves are worth 10 months of imports, cover 10 months of imports. If you look at our foreign balance of payment, is on a positive note. I know all these things, but I still think the overarching objective of the central bank still remains price stability, and price is not on target, is far away from target. At 23.71, despite the rebasing, right, we're still way above what is ideal. What is ideal is 6 to 9%. And even for the 15% that the fiscal authorities are forecasting, 23.71 is still high. And mind you, IMF is even projecting something way higher than what we're seeing now. So I don't think because inflation is not on target that they should be hiking. Mind you, monetary policy has long and variable lag. So if I were in the position, I think I would adopt a wait and see. And because of that, I would likely hold the parameters just like they did the last time they met. In my view, that should be the wisest thing to do. Because if you hike, there are risks attached, and if you say you're loosening, you're trying to reduce subpedal, that might not be ideal because a lot of things have not been achieved. And I'm conscious of the fact that cost of credit is there. I know the Manufacturing Association of Nigeria or manufacturers are bitterly complaining, and even for the PMI that came out, manufacturing is on a positive note, yes, but it's still struggling compared to services. So, but if you look at what the central bank is supposed to do by ensuring price stability, by tackling inflation, they're protecting the purchasing power of not only consumers, but even for the manufacturers. And even if they're protecting only the purchasing power of the consumer, the manufacturers, it helps them in the sense that they don't manufacture things for themselves. They manufacture these items to be bought by people. And if people are pressed out by high inflation, they will not be able to buy. And that's why they have a lot of backlog that they're not able to sell, running into trillions of naira. So I think the ideal thing is everything must be done to bring price back to target at the barest minimum. And I think even though I want inflation to be back to target, I feel this is not the right time to actually hike. So if I were in the shoes, I think I will hold all the parameters steady for now.
All right, talking about that, maybe we should then be looking at, complementary measures to ensure that we bring inflation to what we want it to be. We talked about the 15% proposed by the fiscal authority, but apart from that, you rightly mentioned Nigeria's target, which is 6 to 9%. I mean, when are we going to start that conversation? Is it a conversation we can start now? Doctor, let me get your thoughts on that.
I'm struggling to hear you, sorry. The audio improved for a bit, but I'm struggling to hear you now. I don't know the thing they did the last time so that I can hear better.
Okay, that's fine. So I was talking about Nigeria's inflation targeting. We know that the official target, which was of course announced in 2013, is 6 to 9%. However, we are at 23.7 now, and the fiscal authority's target for this year is 15%. How do we even get to 15%? Is that still possible? And then when can we start talking about getting to the target, which is 6 to 9%?
I'm sorry, I can't hear.
All right, it's okay. I don't know if you heard me. I'm sure you heard me.
Yes, of course. I think that's a conversation about now focusing on increasing output significantly, right? We have had conversations around what more to be done to ensure that prices are significantly reduced. We know where the issues are coming from: logistics costs, insecurity, not allowing us produce as much food, distribution costs being extremely high, the cost of credit being extremely high. So what this just tells us is that we know where the pressure points are, and we just need to do what needs to be done to ensure that output increases. And what this looks like in practical is an increase in, in infrastructure development to support the industries, ensuring that we support small to medium scale, businesses, that they're able to increase output and as well as employ as much people, so that we're not only increasing productivity in terms of output, but also increasing human capital productivity as well. So I think it's a conversation around ensuring that we do what needs to be done to increase Nigeria's productivity level, ensuring that output increases. And we have seen templates all over the world on how best to go about it. And Nigeria is no different really on what needs to be done. Yes, there are niche aspects of each economy, and Nigeria will just have to find its footing on what best to, really double down on. But for instance, we do know that we have top agricultural commodities, and there are, positive prospects for those commodities on a global scale in terms of demand, in terms of market size. So meaning that there is a demand for what you have in-house, but ensuring that we're able to add value to those commodities. For instance, sesame seeds, cocoa, just ensuring that we add value to those commodities and exporting them as much as possible so that we're able to generate substantial revenue. I think those are the aspects that we need to look at. And one more thing I think is extremely important is whenever we are adopting policies, ensuring that we adopt these policies gradually. We have seen how immediate shock significantly, trump economic activities and significantly hike inflation. We have seen that with the border closures that happened during, the Buhari administration. We have also seen that with the sharp removal of fuel subsidies and how that significantly impacted business operations and also, the general inflation environment. So what that tells us is that whenever we want to adopt these moves to significantly bring down prices, we have to do them in a phased approach to ensure that the shocks to the economy are significantly tapered out. And more importantly, like what the IMF had always, advocated for us doing during reform processes, is ensuring that there are social transfers for the most vulnerable in the society. And what that looks like in practical sense is once these people are somewhat, shelved and supported and cushioned, the impact of all of these changes that we will be making production-wise and output-wise and human capital development-wise, they are still able to consume. And remember the national income accounting equation. We have the Y is equal to X, all of that. We do know if the government is spending in the right places, we know that would have a positive impact on GDP. We also know that if consumption increases significantly and that spending is going to the right industries that will also support economic growth. We also know that investments, right, extremely important. So as G plus I plus C. So now we know that investments and what kinds of investment are we really looking at, right? I mentioned infrastructure, I mentioned support for these industries. And what does that look like in practical is long-term investments, right? Ensuring that the economy is positive and happy and encouraging enough for long-term capital to come in. We are seeing this happening on a private capital level, right? But we also need more. And one thing that we have seen private capital investors adopt to ensure that they're able to sustain this long-term capital, but also make sure they're able to generate revenue, is investing in Nigeria with Naira. So rather than investing in the US dollar, they're investing in Naira. The CBN and IFC have some sort of arrangement, and we're also seeing other private capital market players adopt the same method. So they're able to invest for the long term, but more importantly, ensure their returns. And what this does, again, is ensure that output is increasing, output is targeted towards the right sectors. I think one last thing to mention, because I've already mentioned the export part of it, is sustaining all of this is extremely important. And what that means for Nigeria is when all of this comes in, what is our next phase? How do we ensure that all of these gains that we have accrued, we're able to sustain them? And that's where implementation in policy making and interconnected between the political economy works well.
Okay, so we need to go now. We now connect to Abuja, where the CBN governor is giving us the briefing.
In the global and domestic economies, including the risks to the outlook. All 12 members of the committee were in attendance. Decisions of the MPC. The committee was unanimous in its decision to hold policy and thus decided as follows. 1, retain the MPR at 27.50%. 2, retain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3, retain the cash reserve ratio of deposit money banks at 50% and merchant banks at 16%. 4, retain the liquidity ratio at 30%. Considerations. The MPC noted the relative improvements in some key macroeconomic indicators, which are expected to support the overall moderation in prices in the near to medium term. These include the progressive narrowing of the gap between the Nigeria foreign exchange market, NIFEM, and Bureau de Change, BDC windows, the positive balance of payments position, and easing price of PMS. Members also noted with satisfaction the progressive moderation in food inflation, and therefore commended the government for implementing measures to increase food supply, as well as stepping up the fight against insecurity, especially in farming communities. The MPC thus encouraged security agencies to sustain the momentum while government provides necessary inputs to farmers to further boost food production. The committee, however, acknowledged underlying inflationary pressures driven largely by high electricity prices, persistent foreign exchange demand pressure, and other legacy structural factors. The MPC noted new policies introduced by the federal government to boost local production, reduce foreign currency demand pressures, and thus lessen the pass-through to domestic prices. Given the relative stability observed in the foreign exchange market, members urged the bank to sustain the implementation of the ongoing reforms to further boost market confidence. The committee also called on the fiscal authority to strengthen current efforts at enhancing foreign exchange earnings, especially from gas, oil, and non-oil exports. The MPC, however, expressed concerns about the recent decline in crude oil prices attributable to increased production by non-OPEC members, as well as uncertainties associated with U.S. trade policy, which present new challenges for fiscal receipts and budget implementation. The committee reaffirmed the continued stability of the banking system following notable improvements in key performance indicators and observed the appreciable progress in the ongoing recapitalization exercise. Members thus called on the bank to sustain its effective oversight of the industry to ensure compliance with regulatory and macro-prudential guidelines. On the strength of these considerations, and driven by the continued uncertain policy environment, exacerbated by ongoing global shocks, members weighed the available policy options and were unanimous in their decision to hold policy to enable a better understanding of near-term developments. Members reaffirmed their commitment to prioritize policies targeted at anchoring inflation expectations and easing exchange rate pressure. Key developments in the domestic and global economies. According to the National Bureau of Statistics, NBS, headline inflation year on year declined to 23.71% in April 2025, compared with 24.23% in March 2025. On a month-on-month basis, it also declined to 1.86% in April 2025 from 3.9% in the previous month. Both food and core components contributed to the decline in inflation in the period. Food inflation eased further to 21.26% in April 2025 from 21.79% in the previous period. Core inflation also declined to 23.39% in April 2025, compared with 24.43% in March. Real GDP year on year grew by 3.84% in the fourth quarter of 2024, compared with 3.46% in the preceding quarter. This improvement was driven by both the oil and non-oil sectors, with the services sector being the major contributor. Gross external reserves increased by 2.85% to $38.90 billion as at 16th of May 2025, from $37.82 billion at end of March 2025. This represents an import cover of 7.6 months for goods and services. The balance of payments recorded a surplus of $1.10 billion in the fourth quarter of 2024, compared with $4.21 billion in the preceding quarter, on account of moderation in current account surplus. Although global output growth is expected to remain positive despite existing and emerging headwinds, the International Monetary Fund, IMF, downgraded its global growth forecast to 2.8% in 2025 and 3% in 2026, compared with 3.3% in 2024 due to the uncertain policy environment. Members were thus unanimous in their resolution to maintain close surveillance of developments in both the domestic and global environments to enable appropriate policy response to emerging shocks. The next meeting of the committee is scheduled to hold on the 21st and 22nd of July 2025. Thank you.
Thank you very much, Mr. Governor, sir. That was communique number 157, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Oluwole. We now take questions from members of the press. Please state your name, your LinkedIn, and ask questions.
Thank you, Mr. Governor. Good afternoon, members of the MPC. My question is around big players now starting to better Nigeria's macroeconomic comeback story. Recent assessments, of course, suggest that the IMF being paid, World Bank giving a nod to ongoing reforms now. There's also, so I think, Fitch ratings. We also saw Fitch ratings just, I think, a few weeks ago, boosting Nigeria's outlook from stable to positive. On paper, things are looking up, but inflation keeps biting. We just got a report from NBS, I think it was on Monday or so, that inflation now is at 23.78%, still double digit from 24.23%. The real question actually is that if the numbers say we're on the right track, it still does not feel that we're on the right track for Nigerians. How do Nigerians interpret this into meaningful impact? That is my.
And there you have it, the briefing from the 300th Monetary Policy Committee meeting, where we have the committee decide to hold rates. And that's not the only thing. They also maintained the MPR, of course, which is holding rate at 27.5%. They retained the asymmetric corridor at plus 500 to minus 100. And also the CRR for deposit money banks at 50% and for merchant banks at 16%. And then we also see liquidity ratio being maintained at 30%. I still have my panelists right here with me. Thank you so much, Dumebi, for staying with me.
Thank you for having me this long.
Definitely. All right, we'll get back to the CBN governor now.
Very, very positive measure. Now, in terms of how this whole macroeconomic fundamentals are playing out, in spite of the fact, like you said, there have been positive endorsements from all kinds of bodies that make it a point of duty to observe and critique the moves that various countries are making to ensure they have stability in their economies. And your question basically is, well, that may seem positive, but how does that translate to getting the feeling that things are better? Now, I think it's important to say that investors, and let's face it, without investments, economies don't grow. Investors don't go to where there's instability. So I think that is the first thing to understand. On the journey, and this is a journey, investors don't go out to invest to lose money. They go out to invest because there's stability in an economy and they can plan. With that stability comes confidence. With confidence comes investment. And with investment comes growth and output. I think that's definitely the trajectory that you will find in all countries of the world. We obviously have been through a long period of instability. And I think that clearly what is being recognized is that the Nigerian economy is now stable and there's interest in those who want to invest to now invest. Clearly, the inflation numbers themselves speak for themselves, and we've discussed that here, mentioned that here, they speak for themselves. The overall trajectory is in the right direction. Not one particular aspect of managing the economy is a bullet that will solve all the problems. It isn't. It's a multiplicity of different endeavors. And that is why the combination of the efforts that are being made and are yielding results in terms of stability. And don't forget, the central bank is the custodian of stability in an economy. If you look at the exchange rate, for example, volatility has reduced from over 4% a year ago to less than half of 1% around now. So that's an indication of stability. And with the increasing collaboration between the fiscal and the monetary side, definitely the journey that we are going through will begin to yield greater results as time goes on. I have no doubt about that.
Good afternoon, Mr. Governor. My name is Nduka Tej of the Nation newspaper. I have 3 questions for you. One, Nigeria recorded a 6.83 billion balance of payments surplus in 2024 from the result released recently. This signals a renewed economic momentum. But with the rising global risk and threat of external shock, how is the CBN assessing the sustainability of this surplus? That is one. 2, with external reserve rising from $36.6 billion in 2023 to $38.8 billion in 2024, how does this strong reserve position enhance the bank's ability to stabilize the FX market in the face of ongoing global uncertainty? And then thirdly, you've seen currency depreciation following the global response to the U.S. Liberation Day tariff. How are you preparing Nigeria for the resilience amidst heightened global uncertainty? Thank you.
Thank you very much. But on the issue of depreciation of the currency, which obviously everybody is always very interested in, the way I will put it is to say that if you look at and make the comparison between Nigeria during the last month or two, when the whole issue of global tensions got heightened. And let's face it, right now we're in a period of heightened uncertainty. And if you are all observing, you will find that the various currencies of the world were under attack and were having to defend themselves. You find that relative to other countries, Nigeria came out very well indeed. We were able to ensure that our depreciation was very, very modest and that the stability was pretty much there. And that, in my view, was a reflection of a lot of the measures that we had taken prior to this time to stabilize our economy. I dare say that if those actions had not been taken when they were, the results would have been a lot more disastrous. Well, would have been not even more, they would have been disastrous for us. They would have been disastrous for us. So it's a good thing that we started these reforms early and that we stayed the course to the point where we built buffers which are able to withstand shocks that come in. And that really sort of dovetails into your issue of reserves. As with our reserves, and here again, it may be necessary to just make a slight digression to re-emphasize what I'm about to say. We published our reserve numbers recently. And if you observe there, our reserve numbers went up from net reserves went up from slightly over 3 billion US to about 23 billion US, which was a quantum leap in our reserve position. Okay. Again, I would say that all these are happening as a result of transparency in process, ongoing reforms which are giving confidence to many players in that industry who perhaps had been on the sidelines up to that point in time, and are bringing about the results. And I always say that the numbers speak for themselves. Beyond the gross reserves, which are 40 billion as at that time, the net reserves have grown quantumly. And that will continue to be, and that will continue the path whereby we will ensure that we have sufficient buffers beyond the IMF 6-month import cover to ensure that we continue to keep our economy in a safe and sound mode. The sustainability of the surplus you talk about, and again, I must comment that in itself speaks volumes, because you have a situation where beyond just oil prices, in fact, if you look at the oil sector itself, you'll find that the importation had gone down with the Dangote refinery and all the other refineries coming up. The demand obviously will go down. The gas exports have, been on an upward trajectory. Now that we have a competitive currency, and it's something that you will hear me talk about over and over and over again. Our currency now is more competitive. So this should encourage exports. And indeed, for us as Nigeria and Nigerian businessmen, the opportunity to extend that dragnet into our sub-region is also an enormous opportunity now that we have such a competitive currency. So to answer your question, my belief is that if we continue doing the things we have done up to this point in time that have resulted in a positive surplus, we should be able to, in fact, improve that without too much of a problem.
Mr. Governor, sir, members of the MPC, my name is Sarah Chido, Channels TV. Most recently, we saw you engage with Nigerians in the diaspora, as well as meeting with investors to see how they can invest in the country. And then most people have described this initiative as commendable. But the question is, how do you hope to sustain this momentum and then restore confidence, especially with the budget that's been described by many as unrealistic? And then the second question is, how can Nigerians and investors trust that the bank won't fall back into the same old habits that damaged credibility in the past? Thank you.
Thank you very much, Channels. I won't only take your word for the fact that this happened, but your Channels was very well represented at a couple of these fora. So thank you very much for that. Well, first and foremost, let me say that something I've constantly said and will repeat is the fact that we are, at the central bank, we are on a mission to restore confidence and build back trust. We're in a mission to restore confidence and build back trust. And we appreciate the fact that in this journey, we need all stakeholders to find that they are dealing with a central bank that will not disappoint. And that is the reason why some of the things we did and we have done up to this point in time, it may seem like nothing, but it's a big deal. For example, when we talk about publishing our net reserves figure and doing it, there's a reason why these things happen. People have to know that when the central bank says it is going to do something, it does it. We recognize that there's a need to rebuild our institution, the central bank. We recognize that. And I assure you that we are doing everything possible to ensure that that happens. It isn't something that will happen overnight. It's not possible. There are a lot of areas that we literally need to reset completely and start all over again. And we're doing so. But those things do take time. They do take time. But what I want to assure you is that we will be consistent as we have been over the past 18 months. And we believe that once we continue in that direction, we will be successful in building back the trust that has been so badly eroded over a period of time. I'm happy and pleased, I must say, that particularly in the international arena, and you mentioned it, both the IMF and World Bank meetings and the very successful outing that we had in the NASDAQ building in New York, the feedback from those particular engagements have been very positive. And I recall that there was the person that moderated one of these sessions was quoted as saying that they have been covering these activities in Nigeria for so many years. And this is the first time that they have seen so much interest in investors coming to Nigeria, that it is no longer a question of should we be there. It is a question of when we will be there.
CBN Governor and, of course, the Chairman of the Monetary Policy Committee, Olayemi Kadoso, they're answering questions after telling us that the committee has decided to hold rates and hold all other parameters. I still have right here with me Dumebi Oluwole, Senior Economist, Stears. Thank you so much for staying with me.
Yeah, you're welcome.
All right, and I also have Segun Sopitan, Principal Partner, Woodridge and Scott Consulting. Thank you for staying with me.
Thank you.
All right, and yes, I still have Dr. Samson Simon, Chief Economist, ARKK Economics and Data Limited. But of course, I'm informed he's not on the court right now. But let me come to you, Mr. Sopitan. What stood out for you from that communique that was issued by the CBN Governor and Chairman of the MPC?
I mean, I think that for me, what stood out was the information that the CBN governor is providing towards in response to the questions that have been asked by the journalists. Like we said before we went to listen to him, we had all expected, I think the three of us on this panel had expressed the expectation that, we're going to hold. So no surprises there. I think it's just common sense economic management to hold, the rate for now as we begin to observe and determine what direction we're moving in and whether the gains that we're beginning to see in terms of some of the fundamentals that have been driving inflation, whether those gains are sustainable, to the point where we then want to start trying to push more towards growth than price management. So no surprises there. But I think that some of the things that the CBN governor said were quite striking. The growth in the net reserves is significant. It's not news, it's not new news, but it's important to continue to highlight the fact that as against where we were, just 2 years ago, where net reserves had actually dropped to almost below $3 billion. That's crisis level. It's almost to say that the country was pretty much had no future. To then growing that number to 24 billion 2 years later is very commendable. What that means is we've been able to strike off some of the encumbrances on our foreign exchange reserves that we had in place, basically saying that we had been spending our future today. So it means that a lot of the funds that we've received in the last 2 or 3 years have actually been deployed towards freeing up, flexibility for the country, in terms of ability to absorb whatever shocks might happen. So what this means, for example, is that as oil prices begin to continue to fluctuate, as we continue to see the instability and the downward movement in international oil prices, given our dependence as an economy on oil revenues, it means that we're not quite as exposed to those shocks as we would have been if this hadn't improved. So you remember what happened in the COVID period, and also in the 2015, 2016, in the early days of the Buhari administration, when oil prices collapsed and the Nigerian economy basically tanked. What this means is that that won't happen now. And should the need arise, the CBN will be able to defend, the currency and continue to ensure stability. The stability that he also spoke about as being one of the key responsibilities of any central bank, to ensure that investors can hold the confidence that if they bring their monies into the country, whenever they achieve their revenue goals and all of that, they can repatriate their profits without too much concern, because the market, is capable of sustaining whatever demands they have in terms of liquidity requirements. So this is very good. I think the general tone of his speech is optimistic, and I don't see any reason why one shouldn't share in that optimism. One would only hope, that as we move forward, we can begin to see a connect between this positive macroeconomic developments and the average man on the street, because that's where we still have a problem. It's been 2 years, and the people, the dislocations that have been created by the reforms of this administration are still biting very hard on the man on the street. So we would like to see a situation where these policies and these gains begin to connect and affect the man on the street and begin to lift them out of the quagmire that they found themselves in very suddenly and very quickly.
All right, there's a lot to pick from what you have said, whether we want to look at the monetary, the fiscal, or even, the price dynamics that are now stable. There is also the talk about the transmission mechanism, which you landed on. But then there is this concern that some analysts have expressed about the CRR. They are saying that it's supposed to, sort of protect the depositors. However, it's being used at this point to sort of sterilize funds, sterilize liquidity. Let me get your reaction to that before I come to Dumebi, who is here with me in the studio.
Yeah, I've listened to different ideas on this, but I think I would rather err on the side of caution for now, because if you look at the liquidity numbers, they're not encouraging at all, and that's a fundamental driver of inflationary pressure in the economy. We're still looking at liquidity in the economy, total money supply being somewhere around 100 and I think the last count was 114 trillion naira, and if you juxtapose that with the fact that just 2 years ago we were at 56 trillion, that tells you how significant that number is. So before we begin to unsterilize, for want of a better expression, liquidity within the banking system, we've got to see some improvements, in these numbers, and we've got to ask ourselves what's driving, this continued growth in liquidity within the system, in spite of all of the measures of the central bank to rein liquidity in, and to rein money supply in. So until we begin to see that, I think that it's a good idea to continue to retain those ratios to ensure that the banking system doesn't overheat the economy in terms of inflationary pressure. Of course, I'm conscious of the fact that what that also does is that it crowds out credit. It prevents the banks from being able to provide the desperately needed funding to drive development, to drive business, to drive investment, to drive the small and medium scale sector, who are the people that employ the most within the economy. So it's a balancing act, and one would only hope that if we're able to sustain this trajectory over the next 2 to 3 months, maybe 6 months, we can begin to see an easing of some of these constraints that are designed to keep liquidity and money supply in check.
All right, thank you. Now let me come to you, Dumebi. Let's begin from your reaction to what the CBN governor has said. And I think I'll probably like you to start from where we just ended, which is the CRR.
Yeah, I think particularly for me, just like previous speaker had mentioned, it's a balancing act that we need. Obviously, we do know the side effects of keeping the CRR high at 50%, but we also know the side effects of not doing that, right? Which is managing liquidity. We have to manage liquidity and ensuring that we don't have money supply skyrocket too much, because in its sense, you have to remember that what exactly is the goal of the CBN? Why does the CBN exist? It's price stability, right? And to achieve that goal, these are the resources that it has, these are the tools that it has at its disposal. It has the CRR, it has moral suasion, it has being the banker's bank. It also has being a banker it also has being a banker to the federal government. It also has ensuring that price stability is there. So, but at the end of the day, all of these work together to achieve the singular goal of price stability. And in periods like this, where countries take up reforms, all of these tools have to be utilized to ensure that at each point of the market, right, there is some level of support towards ensuring the bigger picture. And that's exactly what this is. It is painful, yes, but do we see a world where it will get better? The answer is yes.
How soon? But well, just looking at, just one of the panelists also mentioned the fact that the Manufacturers Association of Nigeria, the organized private sector, they're all complaining. I mean, it's affecting production, it's affecting so many things.
Yes, I think this is one of those things where I guess more communication with the central bank will do a lot of job in ensuring that they have their ears to the ground to really get the pulse of how this is significantly impacting. Or maybe we need the fiscal authorities to begin to do more. Well, that is also the case as well. Remember that I mentioned to you that the goal of the CBN is to ensure there's price stability. Now, if we look at the other aspect of the fiscal side coming in as well to kind of support and ensure that these industries have the resources that they need to ensure that output is increased and production levels are optimal, you're very right. And I remember before we even went on the break for the CBN, that's exactly what I did mention, right? The investments in infrastructure, supporting these industries, ensuring that they have the resources that they need to increase output. But the point I'm trying to make to you is that what the CBN has done is what it should be supposed to, it should be doing, right? It's not outside of their purview to do what they have done. Remember, monetary policy authorities will follow monetary economics. And what is the simple monetary theory that is guiding what they are doing? Too much money chasing too few goods. We have to adjust the money supply. And we have, the previous speaker had already mentioned, we have seen a significant increase in money supply. And remember, this growth, if you take it back, it did start significantly from the Naira redesign. So from the Naira redesign, we've seen that significant increase, right, in money supply. So this didn't start with the central bank. I remember what the central bank had mentioned, what the CBN governor had mentioned, that what they are trying to do is ensure that we're at a place where they are reinstilling confidence in the economy, and they are doing what needs to be done. They're on a mission to achieve that. So I would say it's a gradual process, right? In periods of reforms, not everything would go as we all plan. It's going to take some time, right? And it definitely requires that balancing. I do not think that the central bank or the central bank governor is not aware of the painful impact of all of this, but that's where that conversation and consolidation and cooperation with the fiscal authorities also coming to achieve all of the other things that I had already mentioned before. Then in terms of the thing that really stood out to me, I'll say this is very strong forward guidance from the central bank governor. We are seeing him speak authoritatively and ensuring that he's instilling confidence, not just with the data he's providing or the steps that he's taking in terms of policy, but also instilling the trust and instilling that confidence in investors. Now, what I literally wrote it down. He said the CBN is on a mission to restore confidence and build back trust. This is strong enough signal to investors that are itching to put their money back in Nigeria. So if an investor was adopting the wait-and-see approach to putting money into Nigeria, this alone tells them that, okay, we can begin to do something. And that's good news for us. Remember the national income accounting I mentioned before? We had seen long-term capital dissipate for a very long time. And that's what we truly need, right? With everything the CBN had done, we had seen FPI inflows increase, but we need more long-term capital.
FDIs.
We need more FDIs. And this will start begin to do that. So if the central bank governor continues on this path of orthodoxy, ensuring strong forward guidance, bringing up all of these signals, we will see these things begin to manifest.
These signals are not enough in themselves. We still need some policy guidance from the fiscal authority.
You're not wrong in that, and I really stand on business in that regard. I'm a very huge proponent of that, in the sense that the fiscal authorities have to begin to do a lot more. And in terms of doing a lot more practically, what that looks like we had mentioned before, ensuring that insecurity is significantly tackled, because when you look at the reason why the central bank is doing what they're doing, which is ensuring price stability, when you trace it back, when you trace down Nigeria's inflation numbers, there are structural factors that cause these numbers to be the way they are. Not necessarily adjusting interest rates, but the central bank has to do what needs to be done to instill that confidence. Remember what the central bank governor said. What they're on a mission of, what their mission is right now is to instill confidence and build back trust. Adjusting the monetary policy tools and doing what they're doing does exactly that. It encourages and boosts investor confidence. It anchors inflation expectations and also anchors exchange rate expectations so that investors know they can bring their money in. But in terms of output, that's where we talk about fiscal policy and what more the government needs to do to encourage that. For instance, in the National Development Report by the World Bank, the most recent one, the World Bank had mentioned the fact that custom due to the recent tariffs that we have on certain commodities and import bans is counterproductive on the Nigerian economy. That's very interesting to hear, knowing fully well that we are trying to rebuild our exports. But when you dig deeper into that, what that tells us is that we are on a reform path, but we're doing it too fast. And by too fast, I mean we're not being gradual with how we're adopting it. And the most painful impact is how quickly it gets to consumers. Now, when tariffs are imposed, when import bans are imposed, and there's not enough self-sufficiency in terms of food production or for those commodities, what happens is that there's scarcity on both fronts and price increases. And who feels this price increase? The consumers. And the CBN doesn't have any control of that. Who has control of these measures? It's the fiscal authorities. So when you look at it in that sense, CBN is doing what needs to be done. Fiscal authorities need to do more. And remember, I had mentioned this before. In periods of reforms, you have to be gradual with the policy implementation, ensuring that these shocks are not too much. And even if they are, you're providing social safety nets for the most affected in society. Because for instance, again, like I mentioned, imagine there's a ban on an import ban on certain commodities and we're not yet producing enough of that. There's scarcity. we're not producing enough, demand is strong, we're not also bringing it in. And this is not to say that I'm encouraging importation of goods. I mean, it's called trade.
It has to be structural.
Of course, that's the point I'm trying to make. And if we still face the issues that we're facing, we do not have year-round food supply for a lot of commodities. We're still struggling with cold storage facilities. We're still struggling with insecurity. These are issues that will continue to impact us. And another thing to also mention is human capital development. Now, if you just as simple as go through Beggar Road, we did a lot of infrastructure developments there, making the roads look good. You see that there were a lot of barricades. I think this was done, in 2022 or 2023. You go there today, all of these things are destroyed. What does that tell us? We have built infrastructure, but people are not incentivized or learned enough to use them. And what that means is that there's human capital deficit, right? And what that also means is that we need to focus on improving the minds of the people that are producing infrastructure for. And here's why this is important. You produce good roads, or you provide good roads, you provide strong facilities, you provide good street lights, but give it 2 years, it's gone. Right. So what that tells us is that even though the fiscal authorities are going to provide this infrastructure, they have to ensure that the minds of the people that they're providing this for are good enough and strong enough to utilize them.
But that's an important thing you're talking about now. It's very important, because at the end of the day, this vandalism we're talking about, they are carried out by the everyday Nigerian.
Of course, and it's not a people problem. It's a resource problem. It's not a people problem, because people will do with what they have, right? If they are properly educated, and this just goes as far as the investments we are making in health and education.
I'm sorry, I'm afraid we need to go very soon. And just before we go, Mr. Sopitan, please confirm if you can hear me.
I can hear you.
All right, so looking at all of the things we've talked about today, there is really a lot to talk about, but let me just stay on this. We've seen improvements, whether it is in the real sector, talking about the PMI. We've also seen improvements in the oil sector, whether you want to talk about the production levels and all of that. How sustainable are these? Let's close on that.
Well, I think that in order to sustain this gain, we need to invest heavily. This is key. And for me, I think this is if there's any takeaway that I would like to leave with this conversation, it's to remind policymakers that at the end of the day, economic management is about the people, right? So if you look at the equation, the national income equation that Dumebi spoke about earlier, right? The investment side of it and the government spending side of it is critical, right, to development and to growth. And what has happened, in the last 2 years and maybe even before then is that we focused a lot of energy on the monetary policy, and we've gotten some of it right. We're getting good sounding numbers, but things are not improving for the average man on the street. And I'm saying the reason for that is that we're not investing enough in infrastructure that will drive development. Look, number one, electricity. I cannot talk about this enough. You can't produce enough goods. So that old definition of inflation where you say too much money chasing too few goods. Well, we've got too much money right now. We've got 114 trillion naira of too much money chasing inadequate food supply, inadequate items that we use, the clothing we wear. We import all of those things. We need to produce them. How do you produce them? You have to have electricity. So we need to convert Nigeria to one large, massive construction site, to a large, massive factory that is producing everything that we need to use. Because as you begin to increase output by making sure that infrastructure for that output is available, then that soaks up the money. Inflation will drop, productivity will increase, GDP will increase, income will increase, prosperity will grow. So at the root of all of this is the activity that we need to undertake to drive output. And for me, the biggest missing link right now is electricity and maybe roads and rail infrastructure, because you still need to evacuate those things from the production centers to the consumption centers. So
absolutely,
we need to see a lot of activity from the fiscal side and from the government authorities to drive the infrastructure base that would help drive development and growth.
Well, these are not short-term projects. They are things that will take some time. But I know that once we start it, we'll definitely get there. Thank you so much for your thoughts and for your time on the show. Segun Sopitan, Principal Partner, Woodridge and Scott Consulting. Thank you for coming.
Thanks for having me.
Dumebi Oluwole, Senior Economist, Stears, thank you so much for staying with me.
Thank you for having me.
And of course, thank you to you for staying with us. Do have a fantastic day. Up next is the news. Stay with us. I am Perpetua Fasoni Peter. Bye for now.